Hey everyone, welcome back. Today's explainer is, well, it's a massive one. We are looking at a true clash of titans. But we're not talking about a battle between two different companies. No, we're looking at a tug-of-war happening right now within a single corporate giant, Toyota. On one hand, you've got this unprecedented, almost unbelievable financial muscle flexing to turbocharge shareholder value. But on the other hand, there are these looming global threats closing in. Volatile macroeconomics, crazy supply chain disruptions, and a complete technological paradigm shift in the auto industry. It's a massive tug-of-war, and we're going to break down exactly what's happening.
Okay, let's dive into this with a number that literally stopped the market in its tracks. 1.2 trillion yen. That is the staggering size of Toyota's historic share buyback program spanning 2024 to 2025. Now, to put that into perspective, this single move is on a completely different planet compared to their historical buybacks. I mean, historically, they usually hovered around 250 billion yen. So this is an aggressive, incredibly confident flex of their immense cash-generating power.
But what really cemented investor trust wasn't just the flashy announcement, it was the execution. There's this Japanese business concept called Yugen Jikko, which roughly translates to actions speak louder than words, and that was on full display here. You see, often companies will announce a huge maximum buyback limit, right? But then they kind of fizzle out and fail to actually utilize the whole frame. Toyota, though, they signaled incredible confidence by completing this massive buyback completely ahead of schedule. They're proving a rock-solid commitment to actually delivering shareholder value.
So here's our roadmap for today's explainer. We'll start with the mega share buyback, then look at unwinding cross-shareholdings, currency and tariff headwinds, geopolitical supply chain risks, and finally, the EV and software race. All right, Section 1, the mega share buyback. The details on this are just incredible. Toyota initially announced a 1 trillion yen frame, which is huge on its own, but then they surprised everyone by bumping it up by another 200 billion yen. And what's truly remarkable here is their precise, disciplined execution. They didn't just blindly hoard stock. They acquired exactly 436.8 million shares for 1.1999 trillion yen. They spent their budget down to the absolute last yen, and they did it well before their April 2025 deadline. And by reducing the total number of outstanding shares, this whole maneuver is mathematically designed to dramatically boost their return on equity or ROE and their earnings per share.
So, the absolutely crucial point here is what happens to all those shares next. They don't just sit in a vault gathering dust. Toyota instantly canceled 520 million shares. That represents 3.19% of their total outstanding stock. That's a massive move. By permanently eliminating those shares from existence, they instantly increase the ownership slice and therefore the value for every single existing shareholder. The big takeaway? By creating scarcity in their own stock, they are artificially and brilliantly engineering higher value for whoever is left holding the remaining shares.
Moving right along to Section 2, unwinding cross-shareholdings.
Now, to really grasp this, we need to understand cross-shareholdings, or mochi-ai kabu. Historically, Japanese companies, especially banks, insurers, and these big manufacturing groups, they would hold each other's stock as a way to solidify their business relationships. It's like a giant, intertwined corporate web, but modern corporate governance really frowns upon this because it locks up capital and drags down overall efficiency. So unwinding this dense web is a massive fundamental shift for the entire Japanese market, and Toyota's approach to this is fascinating.
See, because major insurers like MS&D and Tokyo Marine, along with group companies like Toyota Industries, need to sell off these massive blocks of Toyota stock, you have a problem. If they dumped it all on the open market at once, it would completely crash the share price. So Toyota steps in. They utilize their immense cash reserves to act as a giant safety net. Through what are called self-tender offers, Toyota absorbs these shares directly outside the open market. It's a brilliant way to resolve a huge corporate governance issue without causing a market panic, basically turning a potential vulnerability into a structural strength.
Okay, on to Section 3. Let's look at the bearish forces, starting with currency and tariff headwinds.
Now, what's really interesting about this is the sheer scale of Toyota's currency leverage compared to its domestic rivals. Because Toyota relies so heavily on North American sales, every single time the yen drops by just 1 unit against the US dollar, Toyota's operating profit gets a staggering 50 billion yen boost. Meanwhile, Nissan and Honda are sitting at 12 billion and 10 billion yen respectively. So what does this mean? Toyota benefits massively when the yen is weak, but conversely, they are incredibly exposed to a severe profit crunch if the yen suddenly strengthens. It is a massive double-edged sword.
And speaking of the US market, we absolutely have to talk about trade policies. While a weak yen has been a powerful tailwind for them, the sources indicate that estimated US tariffs are projected to swell from an initial 180 billion yen estimate, all the way up to a massive 1.4 trillion yen annual burden. That is a staggering headwind. We're talking about a level of cost that could heavily offset the massive operational gains Toyota has been making elsewhere.
Which brings us to Section 4, Geopolitical Supply Chain Risks.
Look, geopolitics isn't just news, it translates directly to the bottom line. Instability in the Middle East, specifically threats around the Hormuz Strait, has seriously complicated shipping routes and surged the costs of crucial raw materials like aluminum and naphtha. And this isn't just some theoretical risk. It has already forced a 20,000 vehicle production cut heading into spring 2026. Because of these combined supply chain and material cost pressures, operating profit for the fiscal year ending March 2026 is projected to drop by about 30%, settling around 4 trillion yen. It's a pretty stark reminder that even the most efficient companies in the world are still at the mercy of global geography.
And finally, Section 5, the EV and software race. We are basically watching two totally different philosophies collide here. On one side, you have Toyota's multi-pathway strategy. They are leaning hard into their dominance in highly profitable hybrid vehicles, in fact pushing a record 511,007 electrified units in just a single month recently. But on the other side, global rivals like Tesla and BYD are going all in on a pure EV and SDV, that is, software-defined vehicle strategy. To them, the car is essentially a giant computer on wheels that gets hundreds of over-the-air updates, and they are prioritizing rapid AI and operating system development over traditional mechanical hardware.
And this brilliantly illustrates how investors are reacting to these competing strategies over time. Let's look at the market cap race. Back in 2020, Toyota was actually larger than Tesla. Then, during the absolute peak of the EV hype, Tesla's valuation exploded to more than 4 times that of Toyota. But the pendulum is swinging back. Today, as pure EV sales growth kind of slows down globally and hybrid profits are absolutely soaring, that once massive valuation gap has shrunk to just 1.35 times. And this whole shift was the catalyst for Toyota crossing a historic 60 trillion yen market cap, which is a first for any Japanese company.
So what does this all mean? It leaves us with one massive question. Will Toyota's highly profitable hybrid-heavy multi-pathway strategy ultimately overtake the EV pure plays over the next decade? I mean, they've deployed unprecedented financial muscle to fortify their position and reward shareholders. But as we've seen, those geopolitical and technological bears are heavy, and they are relentless. It's a fascinating corporate chess match, and I highly recommend keeping a close eye on how these opposing forces play out. Thanks for joining me on this explainer, and keep learning.